The next big market crash is coming sooner than you think, and this is what will cause it. I'm your host, Steven Van Metre, and thanks for joining me today. And as investors continue to buy every dip, hoping that any downturn in the market will be met with a Fed bailout, well, this time, there's not going to be a Fed bailout. And the catalyst that will trigger this, well, it's coming soon. Let me walk you through this story and how it plays out. We'll start with Bloomberg with headlines: the Fed eyes rate hike soon and faster tightening pace is needed, and a balance sheet runoff seen starting later this year, according to recent minutes. And the minutes from the January 25th, 26th Federal Open Market Committee meeting released on Wednesday said that most policymakers noted that if inflation does not move down as they expect, it would be appropriate for the committee to remove policy accommodation at a faster pace than they currently anticipate. And as we've been discussing, with food prices and energy prices and rent prices rising, the odds of inflation cooling off by their March meeting, which is 1 month from now, well, odds are pretty low. So we can expect a rate hike. The Mints report tells us they will raise the federal funds rate in March, and that a 50 basis point hike is in play, according to the chief economist for PNC Financial. Given the economy appears to be at full employment, it depends on what inflation looks like ahead of the meeting. Some participants could be looking at the strong January CPI report as a reason to raise by 50 basis points in March. Now, while we do not know for sure if the Fed will raise by 50 basis points, we do know they will likely raise by at least 25. So you can ignore any opinions about a 50 basis point hike, but it's certainly on the table as the Fed listens. Let's continue on with a story. While the minutes highlight the importance of maintaining flexibility, the record contained few new details on the size of the rate hike anticipated in March, nor on the Fed's plans to shrink its bond holdings. A lack of information that investors took as dovish sign as the S&P 500 erased losses and two-year Treasury yields fell. Well, do keep in mind, the Fed never pre-announces what it's going to do, ever. It never does. And so the notion that this is dovish because they didn't put it in the minutes, well, that is actually meaningless. But let's go on, because I need you to understand the story and how it's going to trigger a market crash. The Fed officials responding to high inflation have sped up the taper of their asset purchases and are on track to conclude the program by middle of next month. During the meeting, the FOMC discussed balance sheet runoff plans, and the debate was reflected in the minutes. A number of participants commented that conditions would likely warrant beginning to reduce the size of the balance sheet sometime later this year. And that it means that we could be looking at potentially this summer, more likely this fall, if, of course, the Fed gets that far, and I'm not sure they will, but nevertheless, that's the view. And mind you, there's a lot of importance around this balance sheet runoff, and let me show you what happens when they do as part of the piece of the story here that I need you to understand. And we have in blue the monetary base, and in red, we have 30-year Treasury yields. So here at the end of QE1, where I've circled where the balance sheet was flat, notice how yields collapsed. Now, what is the prevailing view now is that yields are going to rise, but that's not true. Look at the end of QE2 right here where I circled this, where it ended and the balance sheet went flat. What happened to yields? They went down. Toward the end of QE3, yields went down as they were kind of not really tapering at this point, but they kind of tapered it off and let the balance sheet run down a little bit. Yields fell. And notice here when they were tightening and actually seriously unwinding the balance sheet, yields fell. So I want you to understand that the first key component to this is that the probability that interest rates, Treasury yields are going to go down are really high. And how they fit into the catalyst? Well, let's keep going. So in a statement released at its January meeting, the Fed said it expects the process of balance sheet reduction to commence after it's begun raising rates. It also spelled out a plan to significantly shrink the balance sheet over time, while in the longer run holdings, mainly Treasury securities, implied desire should most of its 2.7 trillion mortgage-backed securities that it currently owns. And that's, of course, bad news for the housing market. Now, let's head over to the Wall Street Journal and just get a little more color on this as they headline the Fed eyeing potential for faster rate increases to ease inflation. And this is key. The minutes indicated the Fed officials were satisfied last month with how financial markets had interpreted their recent signaling around the coming rate increases. But the Fed's debate over how fast to raise rates has intensified because of data released since then. And this is really important to understand, because the Fed does not want to destabilize financial markets at all. Now, that's their concern. And now, from an investor standpoint, their belief is, oh, that means the Fed's got my back, so I can take more risk. But I want to show you that the Fed actually doesn't have your back this time at all, but they still want to know how far we can go with this before markets push back. And right now, they're saying, the market's saying, please, raise rates. We're okay. And the Fed likes that. Let's keep going, because they go on to say, but last month's meeting, they cited numerous risks that could keep inflation uncomfortably high, including due to rising rents and persistent wage growth that triggers a more traditional inflationary cycle. They also pointed to risks that inflation rises because of factors outside the Fed's control, such as a Russian invasion of Ukraine, that roils energy markets, or shipping delays made worse by pandemic-driven lockdowns in Asia. And so what we're seeing is the Fed knows that inflation is going to stay high, and they're forced into hiking. Now remember, we talked about how the Powell doesn't want to do this, but he's got to do it. And they're worried, at least initially, about destabilizing the market. But maybe they want that, and actually that would help them. Now let's dig into the minutes, because I want to show you just how important this topic is and how they're going to actually trigger the next market crash. So here you see participants who commented on issues related to financial stability cited a number of factors that could represent potential vulnerabilities to the financial system. A few participants noted that asset valuations were elevated across a range of markets and raised concern that a major realignment of asset prices could contribute to a future downturn. A couple of participants judged that prolonged accommodative financial conditions could be contributing to financial imbalances. A couple of other participants cited reasons why elevated asset valuations might prove to be less of a threat to financial stability than past reversals. So now they're having conversations. It's important to understand that, hey, perhaps this time is different and there won't be a major problem. Or maybe that asset prices have gone up so much that they could come down a bit and it would still be okay, because guess what we're trying to start to understand is there is no Fed put this time. Let's go on to the next paragraph, that they noted the relatively healthy balance sheet positions of households and non-financial firms. So they're saying, hey, you got the money? It's okay. You can handle a downturn. The well-capitalized and liquid banking sector, and the fact that the rise in housing prices was not being fueled by a large increase in mortgage debt, is suggesting the financial system might prove resilient to shocks. Some participants saw emerging risks to financial stability associated with the rapid growth in crypto assets and decentralized financial platforms. The few participants pointed to risks associated with highly leveraged non-bank financial institutions or the potential vulnerability of prime money market funds to a sudden withdrawal of liquidity. And that is the key now, is what you're seeing is they're concerned about this, but not that much, because in the past, the Fed has come to the rescue, and we'll look at that in a moment. But now they're saying, hey, you've got all this money from that fiscal stimulus. You're going to have to rescue the markets if it goes down, and maybe it won't be that bad. But what the Fed doesn't know is just how close they are to triggering this. Let's take a look here, because we look at the monetary base, and you'll notice that you see volatility start to rise at the end of QE1 and at the end of QE2 and at the a little bit after the end of QE3 as a taper, and at the beginning of the balance sheet roll-off and in the middle of it, and of course in the pandemic, suggesting that volatility is about to rise significantly. Now, if you're concerned about how your portfolio could handle a major bear market, a major liquidity crisis, well, you shouldn't be. Be sure to check out Portfolio Shield. You'd be glad you did. There's a link up in the corner and the description below. Let's continue on, because what is the issue now is we're seeing this in the yield curve. Now, there's a reason why I wanted you to understand what was going on with interest rates, because yields fall during these events. And the prevailing view, again, is that's not going to happen. That can't happen. Yields can only and ever go higher from now. But look at this. Here we see from the U.S. Treasury, 30-year Treasury yields are actually lower than 20-year. They're inverted. And look at 5, 7, and 10, 1.92 and 2.03. They're right next to each other. So what is it telling you when you see an inverted yield curve, where you see longer term rates below the next one over, or shorter term rates? It's telling you that inflation expectations are now outpacing growth expectations, and that's bad news. And when you see them all bunched together there, well, it's telling you inflation expectations are near the same level of growth expectations. And when this happens and you see them start to bunch together, banks start curtailing their lending, it's a massive risk off signal. And what do we now learn? Of what the probability here is that rates are going to fall, and that's the danger zone. Look, check this out. Let's go back to the next chart here. And what do we see? I've got 5, 7, 10, 20, and 30-year Treasury yields here. And notice when they get bunched up together, as they're circled here, 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 and right almost where they're at now, what happens next? They go down, and they go down, and they're likely to go down. Now, what if I got these little kind of half circles over? I want you to notice that every time this teal color, this is a 30-year, when the 30-year tends to roll over first, it doesn't always, but it tends to, it signals a change in what's going on. And that's real key, because when you overlay volatility now at these inflection points, what do you notice? That when yields start to collapse lower, volatility starts to spike. And we can see in different events, even small ones here, we get a spike in volatility. Well, what will happen this time? Well, that's a great question, because you may remember a recent video I did where I talked about the volatility index and how that if the VIX gets somewhere over 36, you'll notice between 30 and 36 over the last 2 years, sellers have come in and short volatility. If it breaks out now, what I want you to understand is the Fed's in no position to bail out the markets. They can't do it. They just said, look, we're concerned about financial stability here, but hey, you know what? People have a ton of money. They can bring it to the market and bail it out. And one of the reasons the Fed won't come to the rescue this time, well, that's because inflation's too high. If you look back in the end of QE1, 2, and 3, and I put a red line about where 2% CPI is, you'll notice that the CPI was around their target and was coming down. So they had latitude to do it, but at 7%, not a chance. And another problem the Fed has is they're bailing out the money market, something else we've talked about. There's $1.6 trillion sitting in money markets. So the Fed's saying, hey, we're not going to bail it out. You're going to bail it out. In fact, you know what the best way to deal with high inflation is? Well, that's to have a recession. And one way to get that is to have stock prices come down. But due to the fact that the Fed is actually going to cause yields to collapse, well, that'll mean volatilities will spike, and that will trigger a massive unwind of the volatility complex and all the VIX linked or controlled strategies that will be forced to sell equities to buy bonds, send bond prices higher, tighten financial conditions. And now you've got a snippet of why we are so close to the next big bear market. And it's all going to come at the hands of the Fed. I'm your host, Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or advice. It will have to be construed as a recognition or solicitation by or selling securities, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity, opinions expressed in this video that do not affect the value of advising or Steven Van Metre Financial.